So, but my buddy Frank Capillari did this chart. I thought this kind of summed it up. I mean, I'll get into Monday, kind of the big drop in September and the Green Day, go away in September. But let's just put things in perspective. Oh, this cool chart from Frank. We just had over a 10% uninterrupted rally virtually off of those lows, early August until just recently. So one could say, well, maybe we were just due for a bad day. Well, we had a bad day. We had a bad day. And it's interesting because Monday was the bad day. But even the best years see a couple bad days. So I'm looking at 2% drops. Okay. You got to have a cutoff somewhere. Your average year sees 6 of them. Now, let's be very clear. No such thing as average in this world, right? It's my old statistician joke. Put his head in a bucket of ice, feet in the oven, and said, "How do you feel?" He goes, "Well, on average, I feel pretty good." That's my stat. That's the only joke you'll get, I promise. But
that's a new one.
Yeah, it's an
write
oldie
that
but a
one
goodie.
down.
Yeah, I've used it once or twice. But nonetheless, we've had 3 2% drops. You can see here, some years have a whole bunch, but usually your best years do not have many. But still, just put some context around the fact that, hey, we're up, I think, 14 or 15% on the S&P for the year. We're close to 20, this time on Friday, but then obviously Monday had something to do about that. But let's talk about Monday for a second. So again, over 2% drop on the S&P. We know a lot of it was NVIDIA was down 9%. Tech did really poorly. Semiconductors, I think they're down 5 or 6%. One of the worst days they've seen in a long time. But what got us, I might have talked with you last month about this when we had all that volatility in August, was the action we saw in the U.S. dollar. The U.S. dollar on Monday was up 10 bips, all right, 10 basis points. If it was a true risk-off scenario, if it was a true end of the world is coming, like they keep telling us about, we would have expected the dollar to get more of a bid. It didn't. And then really incredibly to me it has been the last 2 days, the action in high-yield corporate bonds. It's on the right there. High-yield corporate bonds are like higher than they were on Friday, okay? They had a good day yesterday. They were down only 30 basis points or so on Monday. Again, these are just little clues. It doesn't mean we can't have continued weakness in September, can't have continued volatility. But these are things we're watching in August when we had all the scary stuff happen in August. Sonu Varghese, really smart guy, worked with on our team, was like, look at the dollar. Like the dollar has been weakening. The Mexican peso was strong during that sell-off last August. Do you think that's consistent with kind of an end of the world scenario? We would say no, right? So we're following these things. And so far, this looks like your typical pre-election jitters, your September jitters, whatever you want to call it. Nothing out of the ordinary. Let's be very clear. Also, the S&P, everybody, is only been, this is interesting, I think, only been down 1 month this year. It was in April, historically like the best month. So that kind of spins things on its head. But the S&P has been higher 9 of the last 10 months. And now here we are coming into September. Maybe we are due for a break. I mean, that's not the end of the world, but the action we're seeing in the credit markets and with the U.S. dollar to us again suggests any weakness will be fairly contained. Let's call it 5 to 8% probably at the most, and probably a buying opportunity for eventual new highs later this year. This is kind of cool. When you have a bad first day of a month like we just did, down 2%.
Wow.
The rest of the month, so that's not the full month, let me be clear. So that's starting on day 2. The rest of the month has been higher the last 13 times. I don't know. I don't make it up. It is what it is. Now, here's something for everybody. The 2 worst rest of the months ever after a bad first day were, take a guess, September. It's 74 and 2002. You can see I kind of bolded those where the wheels fell off. So you got something for everybody. But just be aware that a bad first day, just simply by itself, the last 13 times we have seen higher markets. I shared this with you probably the last couple times. Bad stuff happens, right? I'm not a trader. I'm an investor. I'm a strategist at an RIA that manages a lot of money for a lot of investors. Just bad things happen. Scary headlines happen. Bad days happen, even in your best years. Just important to remember that. Were there any clues? I mean, this is one I've dusted off. I'm sure I shared it with you before. When you're up 20% in a pre-election year, the election year's never been lower. Sure, maybe you could argue relatively small sample size. I get it, but that's still something that I think was there. Also, I took a look when you're down in a midterm year like we were in 2022. All right. The last 17 times you had an election year or a pre-election year, that's again after you're down in a midterm year like we just were, you're higher. 17 the last 17 times in a pre-election or election year, you're higher after a down midterm year. So just something to think about there. And this is what I share with you. I know a lot. Summer rallies are perfectly normal, perfectly consistent with what you see in an election year. We've said a while. I came on saying don't sell in May, go away. Buy this May, or at least buy this summer. Let me put it that way. And you can see here the best 3 months on average are June, July, and August in an election year, up almost 7.3%. Take a wild guess what we just gained the last 3 months. 7.1% higher every single month. Now I know, okay, well, barely in some of those cases, but nonetheless, higher 3 months in a row. Actually, we're higher 4 months in a row, but higher during those 3 months. So once again, things played out. But then we are coming into, did anyone hear this yet? September is not that great. Yes, it's true. The last 10 years, only month that's down on average. Last 20 years, it is the worst month since 1950. It is the worst month. I call this it is what it is. There's a lot of reasons and people guessing why. I don't know. I could throw out the same reasons. I just know September can be that banana peel month. So let's just be aware of that. But then take a note how strong, November and December tend to be, especially election years, which is this chart. And people worry about September, sure, but just be aware October is the worst month on average in an election year. So I've come on with you for a long time. Say we are bullish. We still think stocks go higher. I'm still in that camp. But what we've done actually, I think I came with you last time. We actually added some treasuries. We had high yield for a good amount of time, which really worked well in the fixed income world. Maybe almost 3 months ago now, when everyone was talking about rate hikes. Remember that? People were actually talking about rate hikes 3 months ago. We added some treasuries because we thought inflation was going to come back and we expected bonds to do much better. So that's worked out. But then you fast forward where we are right now, just 2 weeks ago or so, when we had that bounce, or maybe last week, we had the bounce back to new highs. We added some low volatility ETFs, because how do you do better in a high volatility world? You go low volatility. Not a recommendation, but like SPLV. If you look there, we know there's some defensive stuff in there. What surprised us a little bit, but then when you look into it, there's a good amount of industrials and financials in some of these low vol instruments that are out there. Those are our two favorite groups. We've liked financials all year. I mean, banks, just yesterday, some banks are at an all-time high. So that's been working. So that's kind of where we're still overweight equities, yes, but we are kind of switching things around a little bit in the money we run, expecting potentially your standard September, October volatility. And then we're already talking on our team right now. If we get a 6, 7, 8% correction, what are we going to do? We're going to go back into some of these risk assets. We don't think we're quite there yet, but just be aware of that. Also be aware the second half of September is when the trouble tends to come. And it's funny. It's funny. September 19th is when you peak. Okay, that's my son's birthday. That's the only reason I remember this. But September 19th is also Talk Like a Pirate Day, matey. So when we start to see the weakness, it'll be Talk Like a Pirate Day, just goofy stuff, but easy to remember. Again, sample size of 1, so just take this with a serious grain of salt. But boy, this year looks a lot like last year, doesn't it? I mean, that is amazing how similar these 2 years were. And again, last year we bottomed into October 27th, right at the lows, 10.1% correction. Everybody said the end of the world was near. Your average year bottoms on October 27th. So just kind of be aware, again, that we're in that time frame. I've shared this with you, I think, every time, so I've shared it again. Election years, and you have a president, a new president. And I know what's happened with President Biden stepping down, so this kind of maybe has a major asterisk next to it. But you're up the last 10 years, 12.2% on average, and you have a new president. So it's lame duck years where things get a little squirrely. Now, technically, we don't have a lame duck president right now. Our president is not running again. I'm aware with semantics here, but still, just something to think about. Just a couple more big picture things. August 19th, we saw, this is the data from our friends at Ned Davis Research. We had, which one was my share? Oh, this is a 10-day moving average. So we had over 90% of stocks above their 10-day moving average recently, but just less than 2 weeks before is less than 15%. So that buying thrust, everything's oversold, everything's overbought. October 19th was a big deal. You see the returns there. Higher a year later, what is this? 22 out of 24 times. That's not too bad, with some pretty solid returns there. So just, some things to think about. Also, we had a 90-90 day 2 Fridays ago. And again, this is using, I think it's, what's it called? The multi-cap. Oh, no. Okay. Common operating companies only. Again, this takes out preferreds and bond-like proxies, again, from Ned Davis. But again, 90-90. What's that? 90% of the stocks were up. 90% of the volume was up a couple Fridays ago. It is what it is. You see it there. These tend to resolve higher. Sure, a month or two, who knows what's going to happen. Maybe we do see some volatility and pullback or consolidation. But these are big picture things that, again, suggest to us why we're still overweight equities, why we still like industrials, financials. Our biggest overweight all year, come on, talking about this, is mid caps. Quietly, no one's really talking about them. They're doing pretty well. It's just small caps and large caps is like the Yankees and the Red Sox argument. Mid caps just quietly kind of going higher. The Jane Brady group, if you will. We like that. Just a couple more, not on my bingo cards here. On the left, I know this is the F word, fundamentals on a more of a trading show, but we'll just quickly talk about this. CBO did a projection before the pandemic, this is one on the left, of what the economy is going to do. Economy by that, GDP in the U.S. Our economy is growing faster than what the CBO predicted. That's before a 100-year pandemic, before we shut down the economy, and before the most aggressive Fed and generational high in inflation. We're still growing faster than what they expected. That is why we're at all-time highs. And on the right, real incomes. Yes, inflation's higher than anybody wants. So it's coming back. I've come on for a while saying that. And we think inflation is last year's problem. We started saying that in February. Nonetheless, real incomes continue to increase. There are cracks in the consumer. There are more delinquencies out there. Lower incomes are clearly struggling in a lot of cases. But the honest truth, because if you look at the top, 30% or so, a lot of people are employed, still getting good raises. A lot of people are still spending. Maybe you're not spending as much, right? We wouldn't be surprised at all if you start to see some pullback in spending. It doesn't mean you have to have a recession. We think it's more of a mid-cycle slowdown, and those rate cuts are likely coming, and that can kind of continue to help things. Oh, there we go, rate cuts. I shared this before, but, we call this more of like two more, I think. With a normalization cut, kind of like 84, 95, and honestly, 2019, people get it. 2019, things were good. Fed cut a couple times because they hiked a little too much in 2018. The economy wobbled, didn't fall over. You see the returns there. Historically, you're up, good deal after normalization cuts, as if they're cutting before a recession. And I get it. Nobody knows. Are we headed for a recession or not? We continue to think we are not headed for a recession. The consumer is still spending. Just this morning, the employment backdrop, we had that big spike in claims 5-6 weeks ago. Claims are coming back. We're not seeing any layoffs. We saw a jump in hiring last month in the JOLTS. Now, I know there are still some cracks in labor market, but overall, we still do not see a recession. One other cool thing about this, the Dow made a new high on Friday. I took a look since 1900. 6 months later, our economy has been in a recession 9% of the time, 6 months after a new high in the Dow. What in the world does that mean? Well, since 1900, we've been in a recession 22% of the time. And I know there's a lot more recessions earlier in our country's history. But when you look, it's extremely rare to fall into recession within 6 months after hitting an all-time high. Yes, before COVID had happened. Yes, in 2007 it happened. So those times didn't work. But majority of other times, the best indicator we have for how the economy is doing is the stock market. So let's just kind of remember that. Bull markets last longer. You think this one's almost 2 years old now, from October of 2 years ago. The average one lasts almost 5 years. Who knows how long this will last? We've been saying it for a long time now. Be aware this cycle could go more than you think. Also, your average is the stuff we talk about with advisors and their clients. This is interesting. Your average up year is 19% on the S&P. Okay, so when you're up, any of the up years since 1950, up 19%. Sounds like a really big number. It's actually perfectly normal. But then you're down is 14%. Your average is right around 7 or 8%. So just some big contextual things. The consumer is still strong. This looks at, I don't want to get too into it, but all of the balance sheets, right? There's a lot of debt out there, yes, but there is a lot of assets. There's a lot of equities. People own houses, people own stocks. They've created a lot of wealth. And in a lot of cases, the balance sheets of consumers, it makes people mad when I say it, are in the best shape they've been in 25 years. Okay, because again, this is something we look at there. Last one, I think, I shared this before, but it's from our friends at Bespoke. If you invested $1,000 under Democratic presidents, you have $61,000 right now. $1,000 under only Republican presidents since '53 in Eisenhower. You have $27,000, but took that same 1,000, invested the whole time. $1.7 million. Don't get too worked up about the election when it comes to your investments and politics. All right, I'll stop sharing. I'll take a breath. That was fast. I know. I came out swinging today.
That's like a 6-week course.
Yeah.